So like the beautiful thing about these particular products is, look, no one's promising a ridiculous rate of return. You're not getting a ridiculous rate of return. You're not going to get the same rate of return that you would get if you were to put 20% down on a property and hold it for a 30-year period and have a good quality tenant. But you're also not doing anything for these. You just put the money in and walk away.
Fabio Campanella, welcome back, brother.
What's happening?
I'm good, man.
Been a while, right?
It's been a while. Good to see you again.
Yeah, man.
Yeah, still looking good?
Yeah, I'm wearing the same clothes.
Me too.
There you go. Awesome.
Cool, man. So listen, we're going to talk about infinite banking today. This is a strategy that you introduced to me after Darlene and I went down to Playa Car.
Yep.
And you know Darlene, she's a little bit more conservative.
Yep.
But when she came back, she's like, Gary, I need this property in Mexico.
Right.
And the first person I thought of, Fabio. Fabio can help me figure this shit out.
Yeah.
And that's what I did. I called you up and I'm like, Fabio, how do we buy this property in Mexico?
Right.
And you said, give me a couple days. Let me figure this out. And I think it took you like, 2 or 3 days. And you got back to me.
It took me a couple days.
Yeah.
All right. So took a couple days, but your situation was very, very, very unique. Probably way beyond the scope of what we're going to be talking about. I guess let's kind of rewind it, right?
Okay. And I guess maybe I'll just kind of jump in real quick because and we talked about this before we started rolling, is that there's really kind of 3 ways to build wealth tax-free. One is in your own primary residency. Mm-hmm. The second one is in a tax-free savings account. Mm-hmm. And then the third one is what you just recently implemented for me, which is infinite banking or through a life insurance.
Yes.
Okay.
Yeah. So in Canada, there are very few ways to shelter money legally from tax. The big 3 ways are obviously your principal residence, because you get the principal residence exemption. Okay. There's farming property, okay, which can be sheltered. The shares of a qualified small business corporation can provide some sheltering. And then the big one would be life insurance, and to much lesser extent, a TFSA. Okay. Yeah. So, we rewind it back, and, I always tell people, like I said, I think the last podcast I was on with you, I always tell people, don't let tax drive your investment decisions first and foremost. A bad investment that is tax efficient is still a bad investment.
Right.
Okay. However, tax in Canada, if you are a high income earner, right, or a high net worth family, is going to be likely the number one drain on your family's wealth, right? So, for example, in Ontario, we have the top marginal tax rate is 53.53%.
Yeah, which is so wild.
It's crazy.
Yeah.
So people are like, what the hell? I'm losing 50% of my investment return to the government. Actually, no, it's much worse than that, because you are losing the opportunity to reinvest the pre-tax dollars that you've gained in terms of investment returns. So the longer you are invested in a taxable account, in any taxable account, and the longer you are not accessing a tax shelter, the worse and worse and worse it becomes. I have a chart. I don't even know if it's on my website, but the compound effect, and I've done this on my social media for sure, but the compound effect of tax on your, let's say on a 6% rate of return, okay, reduces your rate of return to 3%, which means that you are losing that compound interest effect over time. And in the end, you end up with something stupid like 25 or 20% of the return that you would have gotten over the long run had the return been tax-free.
Right, because of the tax bracket that you're in.
Yeah,
right.
Because of the loss of the compound interest.
Right.
Okay. So essentially what happens is entrepreneurial type of individuals, capitalistic type of individuals, they naturally drift towards more tax efficient investments. So more tax efficient investments are going to be things like real estate, because you're not taxed on the increase in value of the real estate until you actually sell it. So in tax talk, we kind of say that you have a pregnant capital gain on this particular property, meaning that you have not given birth to that capital gain yet, and it's not a taxable capital gain. So we don't have a wealth tax in Canada. We have an income tax in Canada, meaning that you must trigger the income. Okay.
Right. Are there countries that do that? That have that?
I think there's been
tax?
discussions about a wealth tax. I'm not unaware of a country that actually does have a wealth tax. There might be.
Yeah, because I've heard the U.S. talk about
They've
it.
been talking
right?
about it. Like they have a direct estate tax. They have a gift tax, which we don't have. We're primarily focused on indirect taxes, such as like GST, HST, then taxes on specific items like a luxury tax or gas tax, whatever, property tax, and then the big one being income tax. It's a huge portion of our government's revenues is income tax.
Okay. Yeah.
So income tax, whenever you are getting into that area where you are now considered, let's say, wealthy, right? Which would be the mass affluent category of individuals that have, $100,000 to $1 million of investable assets. So when you eliminate their house, right, you're now starting to get into that area in Canada where, okay, now I'm actually kind of wealthy. Sometimes people call that upper middle class. All right. When you're getting into that area, you are likely in a high tax bracket, somewhere around 40 to 53% in Ontario. Okay. And, maybe you've maxed out your RSPs, you've maxed out your TFSAs. Okay. Or even better, you're self-employed and you have a corporation and you don't want to pull the money out of the corporation because you don't want to get hit with personal tax. Okay?
Right.
So you can only buy so many properties. You can only buy so many stocks, so on and so forth, right? Because you're going to get into the next issue. Okay. When you pivot away from tax inefficient investments, so tax inefficient investments would be GICs, corporate bonds, or interest-bearing securities, which tend to fluctuate in value less than tax-efficient investments, you're going to walk into something called risk. Okay.
Right. And those returns aren't that, like the yields are very low on that, where sometimes now it doesn't even outpace inflation.
For the most part in history, it will not outpace inflation after tax.
Right. So you're actually losing money.
You could be losing money.
Right.
Yes. So what do we do when we're capitalistic and when we're entrepreneurial? We're going to go into something that's more tax efficient with a larger potential for return. So we're going to look at stocks and we're going to look at real estate. We're going to look at hedge funds, blah, 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 blah. Okay. So these are great long-term investments. Real estate, awesome long-term investment, right? Stocks, great long-term investments, but there's trade-offs. Okay. Real estate values go up and down, up and down. Not to the same extent that stocks go up and down, up and down, up and down, right? Stocks really go up and down, up and down, up and down.
Real estate have longer cycles.
It has a longer cycle, right? But the trade-off between stocks and real estate is then the third problem, liquidity, right? If I need money, I can press a button and I get my money right away with stocks. I can't do that with real estate. I got to put up a for sale sign. I got to negotiate deals. I got to do this. I got to do that. Or I got to try to get a mortgage. And
typically it's going to take you a few months to get out of it.
Exactly. And it could take even longer, right? So there's no perfect investment. Okay. You can't get a very high rate of return, have excellent liquidity, and no fluctuation in value. Okay. So what you need to do, what my job is to do is to look at people's situation from the overhead perspective. And I try to integrate their tax plan with their financial plan, with their investment plan, and quarterback, like throw the ball to the right people for every single aspect of their financial plan.
Right.
Right. That's my job so that people understand what I do. Right.
Okay.
So with a lot of these wealthy families, what happens is they are in a lot of real estate, a lot of stocks, okay, let's say, and sitting on cash doing nothing. All right. But tax is a huge issue for them. So what I like to do is I like to arrange a structure that is tax efficient, does not fluctuate in value, gives you a decent return on investment, and gives you access to the capital should you need it for liquidity purposes.
Okay.
And that's where you start getting this concept of infinite banking or leveraged life insurance.
Now, is this beneficial for families that may not have a corporation? Can they still leverage this? Okay. Yeah. So if either or. So if I get a corporation, I can leverage it. Makes probably more sense for me to then move it into life insurance. But if I don't, and I'm just an individual, I got 3 or 4 properties, but I'm building some good wealth, I can still leverage this as well.
Yeah. So this specific strategy that we are going to be discussing today, which would be like a leveraged life insurance type of policy, is going to work for a very specific type of family. Okay. High income earning for sure. This is not people that are, day to day spending everything that they own. So it's high income earning with a surplus of cash coming in on a monthly basis, annual basis, maybe a big bonus or whatever. Okay. And especially for incorporated entrepreneurs who are able to retain cash in their corporations. But a regular family that, mom and dad have high paying jobs, they've bought a couple properties, TFSAs and RSPs are maxed out, and they still have surplus left over after, this is excellent.
Okay. Now, let's say what you just said, somebody's listening to it and they're in that particular situation. Is there an optimal time to do it in your 30s, in your 40s, in your 50s? Does it matter?
Generally speaking, people can't do this until their mid 30s because they don't have the cash flow. Okay. But the optimal time period I've seen is between age 35 and 55 for this particular strategy.
Okay.
That doesn't mean that there are not life insurance tax planning strategies for people earlier than that or later than that. There are a ton of life insurance strategies that can be implemented, but this specific strategy works best between age 35 and 55, that 20-year span.
Right. And there's three things I think that this really does, right? One is that it still allows you to purchase investment properties, right? Because you're going to get some dividends out of it. Is it dividends?
Yeah.
Okay.
Yeah.
Number two, it's going to supplement your income at retirement.
It can, yes.
And then number three, it's going to allow for that death benefit at the end and liquidity for your kids.
Yes.
When that unfortunate day happens.
So, well, I mean, it's fortunate, unfortunate, depending on how you look at it, right? Depending if you're the beneficiary or it's you dying.
Right. Nobody escapes this alive.
Yeah. So let's look at the realities of life. Okay. There's only a couple guarantees. And the two that people joke about, which are real, are death and taxes, right? You are guaranteed to die. Right. It is going to happen one day. And at some point in time, you are going to have to pay taxes.
Maybe ChatGPT can help.
Yeah, I don't know. I played around with it. It's not that impressive.
Not yet anyways.
But soon. So ultimately though, you are going to die. And you are going to leave a bit of a mess in the wake of your death, right? Financial, so on and so forth.
Yep.
So what we need to do is we need to figure out a way to store your wealth in a safe way and in a tax efficient way, grow your wealth in a predictable manner with a decent return on investment, tax free, and we need to be able to access that money during your lifetime and when you most need it at death. Okay. And infinite banking or leveraged life insurance, utilizing something called a participating whole life policy, in my opinion, is the best way to do this. Okay. So do you want to go, let's say, perhaps over the steps? Or do you want further clarification?
Yeah, no. Let's go through the steps. Okay. Like how we set this all up.
Okay. So whether you're incorporated or not, it's very similar steps. We'll start with a non-incorporated family that does not earn their living through a corporation, but instead they are high income earners. They get a T4, let's say. Okay. This family will have after-tax dollars, either from a bonus or whatever, left over at one point in the year. What they will do usually is enter into a joint last to die participating whole life policy. So mom and dad will both be jointly on this policy as the insured individuals on a joint last to die basis, meaning that the death benefit on this policy will be triggered and paid to the beneficiaries or to the estate, whoever the beneficiaries are, okay, when the second of them die.
Right. So I cannot, let's say now I go first, Darlene is not going to get any of those funds.
Yeah.
But she'll continue to get the dividend payments that has been invested in it over the years.
Yeah.
Okay.
And we can get, obviously we do it a lot without breaching confidentiality. A person that we both know, what we've done here is one particular person in the two is primarily the breadwinner, with the second individual providing support to that particular person, right?
Right.
So if the breadwinner were to die, the business is done. So we layer on a risk protection factor by putting on a very cheap 20-year term policy to cover the risk of early death of that one individual.
Now, what if somebody comes to you and they already have life insurance? So you don't need that added benefit of, say, 20-year term, because they might have already have something like that.
Exactly. If they are covered from a risk perspective already, then we don't need it.
Right. So this, what we're creating now, is just an added benefit.
Yeah.
Okay.
So to keep it simple, it's mom and dad will take a joint last to die life insurance policy. Why do we do that? We do that for, very specifically, the insurance component becomes cheaper, because statistically speaking, the chances or the probability of both parties dying early is slim to none. Therefore, we get the equivalent age of someone much younger, of an individual policy of a person that's younger. So we get more insurance for the same amount of money.
Okay.
Then what happens is we enter into a permanent life insurance policy called a participating whole life policy. What does that mean? Under current Canadian tax rules, right, current Canadian tax laws, you can essentially over-contribute to the policy, usually to the tune of about 10 times the base premium, okay, into paid up additions or a cash account, let's say, okay? So you'll see something called the cash surrender value, right? So you make a payment into the policy, a portion of it will disappear. You're not seeing that investment until you actually die, okay? And that'll come in terms of the death benefit. But a large portion of that will go to the cash account or the cash surrender value, meaning that you have access to that cash. It is invested on your behalf.
Got it. Yep.
We put it into a participating whole life policy. And there's a bunch of other different policies, like a universal life policy, where you can pick and choose your investments. Ignore that. We put it into a participating whole life policy. Why? Because we're giving the policy the money into a pot. It's called a participating account, which is professionally invested in a very conservative and highly regulated manner.
Okay. Now, when you say conservative, how conservative? What type of returns can you typically see?
So generally speaking, the type of returns that you're going to see will follow the prime interest rate over time. Okay. So the major insurance companies right now are paying about just a little bit over 6% of a policy dividend. That's announced at a certain particular time of the year. And then once they announce it, you get it.
And is that monthly or yearly?
I believe it's paid once per year.
Once per year. Okay.
Right.
And then that's my income, my supplement income, right? No, that's different.
We'll get to that later.
Okay.
So you enter into the whole life policy and you contribute to it in such a manner that you are building up a cash value. Okay. That cash value, it is considered your asset. You own it, right?
Yep.
It's your asset. Then in the policy,
and that's the funds that I'm putting in yearly.
Correct.
For if it's 8 years or 10 years or whatever
it is, 20 years, even for life, you can put it in for some policies. They go for life. Okay. Then that cash value is going to get dividends based on the investment returns that the managers get on the big, huge, multi-billion-dollar pot of assets that they have. Okay.
Right.
These dividends come in. We set them to paid up additions, meaning they buy you paid up additional insurance. Because we've done that and because you haven't cashed them out, the dividend is tax-free.
Okay.
So the investment grows like a TFSA.
And so those are then getting reinvested.
They get reinvested into the pot.
Okay.
And they buy paid up additions, and then they're available for dividends in the next year. So what happens here is you get basically almost like compound interest, right? Or compounded dividends from this pool of assets year over year over year over year over year, right? It takes a bit of time, but over time with the tax-free compounding, you start getting pretty decent returns. But the next step, the reason that we do it like this, And the reason that we don't use, let's say, a universal life policy where we can invest in the stock market is that it's nice and smooth and predictable.
Right.
Okay. So there's an underlying portfolio of assets that has a performance like any other portfolio of assets, right? So let's say a major, I don't like to give names of companies, right? Because I don't want to be seen as trying to sell their product, right? But one of the major life insurance companies, their participating account has stocks, it has real estate. And when I say real estate, it's not like individual homes. It's like these massive properties fully paid with anchor tenants, right? It's got corporate bonds, government bonds, mortgages, infrastructure loans, so on and so, like a wide variety of investments.
Right.
But the beautiful thing about it is they are allowed to implement techniques called smoothing techniques or institutional smoothing techniques, which allows them to offset gains and losses in different years to smooth out the return and to smooth out the dividend that gets paid.
Yeah. And what I really liked as well, too, is when you did the webinar, you showed that one particular slide over a fairly long period of time, and it's incredibly smooth, very stable,
very stable and smooth.
Yeah.
The way that I like, it's actually, when you look at it, there's a measure in statistics, you learn in like statistics 101. It's called the standard deviation, right? I mean, I'm not going to bore people with what it is, but essentially it is a measure by which the returns deviate from the long-term average. Okay. In essence, that's what it is. Okay. And what happens here is if you compare the standard deviation of most of these participating accounts, the returns in comparison to the average, they deviate from the average less than even 5-year GICs, which have a very low standard deviation. So when you plot the returns versus any asset class, real estate, bonds, GICs, especially the stock market, you see this line that just cuts through the noise. And it's just predictable, stable, and dependable.
Yeah, that's what I really liked about it as well, too, when I saw that one particular slide. Now, this is not a new concept, is it, Fabio? Like how long has this been around? And why does it seem like it's making this comeback all of a sudden? Or is it just
It's always been around.
Yeah.
Just it's not something that, the insurance companies are going to take out ads for and this, that, and the other. These particular policies have always been around and they've always been accessed by wealthy families, right? Why does it seem to, a lot of people say, why have I never heard of this? Well, you probably didn't come from a really wealthy family.
Right.
That's probably why.
Right.
And you are first generational wealth.
Right.
Right. So a lot of the people I deal with are first generational wealth.
And it probably seems like that now because we've been investing in real estate for a number of years. And, there's a group of investors around us that are doing it. And now their accountant is getting a little savvier for them saying, hey, look, you're here now. This is what you should implement.
Yeah. And it's also complex, right?
Right.
But it's been around for a long time. So, the largest participating account in Canada has, I think it's 1887. When
I saw that in the slide.
When they first
I thought it was a typo. So 1800s.
Yeah. That's when they first started paying dividends. They have not missed a beat. Every single year has had the policyholders have gotten a dividend every single year and have never had a negative year.
That's crazy.
Right? So the beautiful thing about these particular products is, look, no one's promising a ridiculous rate of return. You're not getting a ridiculous rate of return. You're not going to get the same rate of return that you would get if you were to put 20% down on a property and hold it for a 30-year period and have a good quality tenant. But you're also not doing anything for these. You just put the money in and walk away.
Right. Okay. So now I want to get into the part of it where I think a lot of investors are intrigued with, which is now the funds are in there. It's being reinvested. You're not going to take the funds out.
No.
But you can borrow against those funds. So now you've got, let's say, we'll throw a number out there. You got 500,000 now in there. You can actually borrow against that. How does that work?
Yeah. So a lot of people use these products as an alternative to fixed income. saying, listen, my portion that I would normally have been putting into fixed income, I'm going to put into this product, and I'm never going to borrow against it. I'm never going to access it. I'm just going to use it for the death benefit. Okay. Totally viable. Now let's get a little bit more sophisticated. We've built this asset up. We're happy. It's tax-free. It's a tax-free vehicle. And I'm getting a very, very reasonable rate of return on it. And it's a predictable rate of return, and it never goes negative. Okay. I mean, anything can happen in the world, but let's just say highly unlikely to lose money.
Right. Yeah.
Okay. But I have a problem. I want to access this because I have other investment opportunities. And this is where you start getting creative. You can access these policies, the cash value of these policies, in 3 ways. You can surrender partially or fully. Not a very good idea because that could trigger tax. Also, it reduces the size of the policy forever, right?
Oh, so hold on. It could trigger a tax?
Yes, when you surrender a policy during your lifetime.
So which you don't want to do.
You don't want to do that.
Okay.
You can take a policy loan from the insurance company. That is a really great way to get quick money if you're in a pinch. Okay. However, the way that the tax...
Sorry, so let's dive a little into that then. So what do you mean by that? So I can actually go to whoever this
ABC,
policy is with.
You're with ABC Life Insurance Company.
Yep.
You've built up cash value. They, in their contract, must provide a policy loan if you want it.
What type of interest would they charge?
Obviously, they because you're paying interest to all the other participating holders that are participating in the policy, it's going to be higher than the dividend.
Right. So you could be into the 10%. So if that dividend is paying out 6%, just throw numbers out.
Yeah.
It might be 10. Okay.
I in all honesty, none of my clients are borrowing against their policies.
Okay.
Because I make sure that they are not overdoing it when they put into these things. Right. So I haven't even been paying attention because none of my clients are borrowing, but it's going to be prime plus a spread.
Right.
Okay.
Because they got to make their money.
They got to make their money. And everybody else who's participating in this is like, hey, if we're lending you money, we need to at least get what the dividend rate is.
It would almost be like going to like a private lender. They're going to charge you a little bit more.
It's going to be like getting a line of credit at a bank. You're going to pay for it.
Okay.
But it's quick, easy, and it's great if you're in a pinch and you need fast money.
Okay.
Okay. But it's not the best overall. You're going to get a crappier rate. And based on the newer tax rules, it can trigger tax. It can be considered like a surrender of the policy. Okay. Now, there's tax rules where when you repay the loan, you can modify, you get your tax back, blah, blah, blah. But that's way beyond the scope of this, of what we're talking about.
Okay.
So the third way to do this is to post the policy's cash value or to post the policy as collateral to an external lender and take a loan or a line of credit or a series of loans against that policy.
And who could you go to for that?
Pretty much all the major banks.
So TD Bank, Scotia, doesn't matter.
All the major banks, plus many of the credit unions.
So am I essentially walking in there with my policy?
Yes.
And saying, hey, look, I want a loan against this?
Yes. And for example, one of the ones that I like is something called a margin secured line of credit. That's what you kind of call it. And it's like, you can access 75 to 90% of the value of that policy with relatively 75% minimal underwriting. Underwriting. You can go 75% loan to value.
Because it's such a well-known product.
Because it's such a steady product that the banks are more than willing. Like they're like, listen, imagine it's like a piece of property that in the history of property has never gone negative in value.
That's so crazy.
Has always had a return on investment every single year, right? Here's 75% loan to value. It looks amazing on the bank's balance sheet. And they're happy to give it to you at prime +1 or less.
Right. So they're not even worried about, are we in a bubble in the real estate market?
They don't give a damn.
Yeah, because it's so stable.
And they're not even going to report it to the credit bureaus. Right?
Yeah. It almost seems more stable than real estate.
Well, It is.
It is.
It is more stable than real estate in terms of the historically what's happened with these particular products. But if you think about it, real estate, you're taking on more risk and you're doing more work. So you should be, over the very long run, rewarded more handsomely with real estate.
Right. Yeah. I mean, look, there's more things you can do with real estate: forced appreciation, higher and best use. Right.
Yeah,
You're right.
yeah.
Exactly.
So it's not a comparable asset class to real estate. It is something specifically for something else.
Right.
Right.
And this is kind of when you're getting into now your later years, and where you're really getting to that strategic planning of, okay, what are these years going to look like, and what else can I continue to do with my funds?
Well, yeah. So in essence, though, to keep the conversation concentrated on what you wanted to talk about, the infinite banking or the leveraging of the policy, the idea here is we're entering into a very high cash value policy because there's multiple different products out there.
Mm-hmm.
If we're looking more for the death benefit, we're going to go into something that has lower upfront cash value because we're going to pay into the pot and then sacrifice the cash value. We'll get cash value down the road. And for dollar, we're going to get more of a death benefit.
Right.
Right. Or let's say we want no cash value because we want to convert what would otherwise be taxable income in a corporation into non-taxable income. That's a different policy altogether. But in this particular case, we're looking for upfront cash values that are high so that we can leverage the policy quickly to do whatever it is that we want. Okay. So the idea would be here, we have money over here.
Mm-hmm.
We know we need life insurance because we're going to have an estate issues with tax, and we're going to need estate liquidity, or we have 3 kids, 2 kids want the property, the 2 kids want the properties that the family has. The other kid wants cash. Where are we going to get the cash from? Life insurance. Right. So we have a need for life insurance, permanent life insurance. We have excess cash. We dump it in, build up the cash value, layer on a line of credit, borrow against the line of credit, invest in something that is going to pay us a better rate of return than the line of credit interest.
Right.
Now we have an ultra tax efficient double dipping investment vehicle.
Now, can you write off the interest?
It's a complicated question, but if it's done correctly, yes. You can write off the interest, and you can also write off a portion of the actual cost of the premiums.
When you say complicated, what do you mean? Like what?
It's based on the regular can I write off interest rules, right?
Okay.
So you have to show a clear path without getting into the details. You have to show a clear path of I've borrowed this money and it's directly going into another investment that has a high potential of triggering taxable income. Okay. Rents, royalties, dividends, interest. Those are the big things. If you take it and you invest in Bitcoin, Bitcoin's never going to pay you a dividend, interest, rents, or royalties, just capital gain. Right. So, but if you take it, you borrow, and you put it in to fund, let's say, a real estate project or something like that, right? Now we're getting into the area where, yes, as long as you haven't integrated that money into personal life and it's directly used for investing in that particular real estate project or second mortgages. I've seen this being done with like high yield mortgages. Now we're entering into an area where, yes, I can write off the interest. And if you can write off the interest, you can also take a portion of the let's call it the net cost of insurance. Okay. So you can, if your premium is 50 grand a year, then the proportion of that premium that relates to the size of the loan as a proportion to the death benefit, you can take that as a collateral interest deduction as well on your taxes.
Right. Now, people, they get the loan, they use it to continue to invest. But as they get older now, let's talk about the supplement income part of it.
Yeah.
Is this if you're investing enough into it, it's enough where it would now, you don't have to even worry about a pension? Is this kind of now replacing that?
It's possible, yeah. So what happens with people, especially like self-employed people or people that have built up a lot of assets, they retire and they're like, okay, well, I'm not in this magical low tax bracket that I thought I was going to be in. You hit age 71, you're forced to take your RSPs out via a RIF. You have CPP, you have OAS, you have dividends coming in from your taxable investment portfolio. You have rents coming in from the 5-6 rental properties that you hold, right? You're still in a position where, hey, I'm in a high tax bracket. So if you want to supplement your retirement, right, rather than triggering gains on your stocks, right, and selling your stocks and triggering gains on an annual basis, right, rather than selling a property and triggering a capital gain, you can tap into the cash value of your life insurance policy that you've built up by collateralizing it, taking a loan against it or a series of loans, and you don't even have to pay the interest as long as you're not breaking the 90% loan to value.
So hold on. So is it not a dividend that gets paid monthly that I take out? No, I'm collateralizing it.
You want to collateralize it, and you could take a series of loans on a monthly basis or whatever, or you want more flexibility. You could take it all up front to buy a property down south or whatever it is that you want to do. There's a lot of flexibility in these arrangements, right? But the idea is you are borrowing against the policy to create a pension for yourself.
Got it. Okay.
Rather than, you still do not take the policy dividends as cash. You let that 6% or whatever it is at the time go to paid up additions. You're still getting the dividend, but what's happening is you're borrowing against it instead, which does not trigger tax. So you're basically getting a tax-free pension.
Okay. So yes, so there never comes a point in time where you actually take those funds up, because that's part of surrendering, which is what you don't want to do.
Correct.
So you want those dividends to keep getting reinvested, to continue to keep growing that policy, and then you can continue to borrow as it continues to grow. Say, hey, look, I need another 30,000, or I need another
take it
70,000. However big it's growing.
Exactly.
Got it.
Like, take it. Right.
Okay.
So you can borrow against it, use it for whatever you want. Now, if you're using it for personal use, you cannot write off the interest. Okay.
Okay.
Because it's for personal use, and that's the same whether you borrow against a rental property or any borrowing. Okay. So you could even allow the interest to capitalize. You don't necessarily have to pay the interest.
But so let's walk through it then. So then now let's say I take out 100,000.
Yeah.
Okay. Now I've got to pay the interest on it to.
No, you don't have to pay the interest. You can allow it to capitalize if you want.
Yeah, but if I'm getting that loan from the bank,
am
I missing something here? So am I getting that loan from the bank, 100,000? I got to pay them.
No, you don't. You don't necessarily have to. It depends on how you've structured the loan. Because of the stability of the participating account and the stability of the dividend, the bank does not necessarily need you to service the loan in any fashion whatsoever. As long as you don't.
That's the part I think
Yes.
That's so crazy. That's like a light bulb moment for me.
Yeah. So it's like a reverse mortgage.
Got it. So they know that it's so secure. They'll give me 100,000, but I don't need to pay the interest on it.
And depending on the size of the cash, the pot in the cash value, they can give you $100,000 a year and just allow it to go, because they know you've assigned the death benefit to them. So therefore, when you die, it will automatically extinguish the loan. It'll pay the loan off plus the accrued interest.
Got it.
With the remainder going to your
estate.
estate.
Then you also the remainder then. So you obviously want to make sure you have enough in there for the kids and for the estate or whatever.
Yes.
And you're going to say, okay, I'm going to pull out this for us to live on or to invest with.
Exactly.
Got it.
So and you don't really have to think about that, because the bank is not going to go over 90% loan to value. Right. On the cash value. And for these particular policies, your cash value and death benefit don't converge until like age 90 to 100, which is when you're supposed to be dead anyways.
So essentially what you could also do now, so let's say now you get 100,000 from them, instead of now burning through it, because now, you're not selling things or you're not as active as you used to be. You could take that, you can then lend it, and then get, I guess, a monthly cash flow from that as well too. Would that be beneficial?
But you would have to be lending it at a rate higher than the interest on the loan to make it financially worthwhile. The way I see it play out for the most part Okay.
Yeah.
Is these particular products, this strategy is not infinite banking. This is called an IRP, or an insured retirement plan. Okay. It's a different strategy, similar concept though. These IRPs are usually, what happens is the couple, or they usually are like, by the time they retire, they're wealthy.
Right.
They don't usually tap into the insurance policy that much, right? So let's say they've got $1 million of cash value in their life insurance policy. They're looking at it. They're like, look, we've got 5 houses that are pretty much paid up. What they utilize the life insurance policy for is, okay, one of the properties that we have needs a reno. I'm going to borrow against the policy, pop it into the reno, and it's a nice quick way to do it. And then they take a deduction for the interest, right?
Right.
Or they're like, you know what? I want to I want to pay for my grandchild's graduate school, borrow $100,000, do that. It's more of a flexibility thing rather than taking it as a pension.
Got it.
Right?
Okay.
Because their RSPs are maxed out, TFSAs are maxed out. They have rental properties, they have stocks. They've got an inheritance from their parents because their parents died when they were in their 60s, when these people hit their late 50s and 60s. They end up not using the policy to create a pension for themselves. They end up using it ad hoc as they need cash.
Got it. Okay. Are there any other benefits or anything that we didn't talk about in regards to this whole infinite banking? What
I want to talk about is the risks.
Yes.
Okay. Because that's one thing. Whenever you hear about a podcast on this stuff, it's usually a person that's not that I'm trying to like downplay people, and everybody has the right to make a living, but I feel like they're just salespeople, right?
Yeah, we always hear just always the good part of it, right? You don't hear the right.
What I like to do when I'm structuring these types of deals, and once again, I'm looking at the whole situation, right? I want to make sure that once again, if the number one, the first use of insurance is to cover a risk of early death. Do we have adequate coverage there? If the answer is no, we got to make sure we have adequate coverage. Okay. For the replacement of future lost income. If somebody dies early, car accident, whatever it is, right? Cancer, heart attack, anything can happen. Number 2 is there an actual need for the death benefit? Because if there isn't a need for the death benefit, I'm gonna scrutinize the plan more closely, because it takes time to build up the cash value. It's not something that can be built up immediately. It usually takes about 5 years to break even on payments, and then we're good. Okay. So if it's a family that, or a couple that doesn't have children, and, usually they have like nieces and nephews, or even a charity that they're, a church or a charity, then okay, there's still a need for the death benefit. But if they're like, I just want to spend it all, I don't care about anybody, then it's like, okay, I'm going to look at alternatives in comparison to this as well, rather than structuring it only like this. And you know what? Sometimes it still works out better with life insurance. Okay. So A, there has to be a need for the life insurance. B, they have to be in a financial position where they can contribute enough to start accessing these leveraging programs, rather than going, so if you don't have $50,000, $60,000 of cash value, who are you going to borrow? Are you going to get good terms?
Right.
You're going to probably borrow from the life insurance company themselves, which I already told you is not the most tax efficient thing to do. Okay. And then what kind of earnings do you have? Are they sustainable earnings? Are you, did you just start making good money? And now it's like, I just started making $300,000 a year. And all right, well, is it a sustainable job, or did you kind of get lucky with something like a good bonus last year or whatever? And do you really want to commit $100,000 a year to this type of thing?
Right.
Because when you get into these arrangements, you're committed 10, 20, 15, 30 years based on the illustration that we've put together. Right. So what I like to do as a means of risk mitigation is, okay, does the family have 5 years of payments in cash? That's a pretty good one that I like to use. has the couple been earning the money that they're earning for at least 5 to 10 years? Right? That's another good one. Right?
Yeah.
What other assets do
they're
they
consistent.
have? Yeah. What other assets? And what is their attitude towards money? I'm very hesitant with, like I get doctors or whatever professionals that come to me and they're like, yeah, I want to do this. And I want to do something called an IFA, which is even more aggressive than like this infinite banking, right? Where, you're going to put in 150 grand a year into this policy and then immediately borrow 150 grand by posting the policy and other assets as collateral.
Okay.
I'm like, okay, well, you realize 10 years from now, you're going to have a $1.5 million loan.
Right.
Are you going to be able to service that if something bad happens or blah? So you've got to be very careful. You've got to understand how leverage and leveraged investments work. So if the client is uneducated with that, I'm hesitant to do these types of arrangement. I'm like, look, let's do a smaller policy and just bank that as your ultra safe, worst case scenario money.
Yeah. And that's going to be sometimes, I guess, something that you see a lot of times where all of a sudden now you've got this investor that comes to you and say, hey, look, man, I want to implement this strategy because I just saw it on a webinar and I need it done like this.
Exactly. And more often than not, like, I'm dealing with amazing family right now that they're in the mortgage industry, super sophisticated. They do like a lot of these like private mortgages and they do it with their own money, right? And they were presented, they came to me because they didn't like what they were presented by one of the big, some advisor that was referred to by one of their private bankers. And they were presented with this extravagant thing where they were going to put in like $250,000 a year into this policy, borrow against it right away. And then they're like, Fab, like the spreadsheets look good. I'm like, look, guys, I can make a spreadsheet look good to anybody.
Yeah.
Right. The reality is you're going to be committing $250,000 a year to this thing every single year. The way it was presented was for life because it was a life pay policy. Right. And you're going to borrow back $250,000. 10 years from now, you're going to have a $2.5 million loan. You're going to have to service the interest rate on that, right? Are you sure you're going to be able to find $2.5 million of deals that you can borrow against that 2.5 to put into? Or are you going to tap yourself out at $1 million deals? I don't know. Why don't we do something less aggressive? Limit your borrowing, or at least the modeling of your borrowing, to 75% loan to value on the cash value and save the rest for the estate. Because I don't know if you guys are going to continue to get good rates on your private mortgages or if the private mortgage, private mortgages are going to dry up. I don't know.
Right.
Let's save that rest for the estate because I know for sure you're going to have an estate tax due. Right. So for that particular family, it was a much lower amount that they were paying into it with a less aggressive borrowing strategy.
Right. Yeah. Listen, you know what? It's a very intriguing strategy. I think it's obviously not going to work for everybody, but if they're in a particular situation, if they're getting into that wealth state now, this is something that they should definitely take a look at, right? And they've got a few properties and saying, hey, what does my future look like? And this is where I think they start to take a look at it and visit it. And
it's definitely worth looking at. And it's not the only strategy that can be implemented and beneficial when it comes to life insurance. There are a multitude of strategies that can be utilized, right? So it's definitely, if you have properties and you have good cash flow in your family, these types of strategies are worth looking at. They're definitely worth looking at and looking at the alternatives.
Awesome. Right. Fabio, listen, I appreciate your time again. Anybody who's interested, want to learn more about infinite banking, how can they get a hold of you? And do you have staff that deals with this, or do you partner? You partner with another company?
I partner with other people. I actually have a life insurance license myself.
Oh, I didn't know that.
Yeah. I've had one for a long time. But I prefer to act as the quarterback and look at things from the big picture perspective, rather than zeroing in on one. So I am life insurance licensed, and I'm also securities licensed. So I can manage people's RSPs, TFSAs, corporate accounts.
Okay.
I have a securities license as well.
Right.
So I can do all these things myself, but I often bring in specialists for this, that, or the other.
Right.
And I'm the quarterback.
Right. So you like kind of creating that whole strategy and saying, okay, I need you to go to this player over here. I need you to go to this player over there.
And I find that works better because then my mind is not set on one solution. If I was just an insurance guy, insurance is the solution for everything because that's all I can sell.
Right.
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 So I'm looking at it like, okay, maybe this family insurance isn't for them. So I'm not even going to go down that road. You know what I mean?
Right. Yeah. Which is good though, right? Because the person that's coming to you or the family that's coming to you, they want that unbiased solution and overview to saying, okay, well, I'm not only going to sell you this because, hey, maybe we should take a look at this particular product over here.
Exactly.
Yeah.
Right. And it's like, I'm not going to discourage you from buying real estate or stocks.
Right.
Right. Because that might be the best solution for you. But the best way to find out about me, honestly, is CampanellaGroup.com. We don't have a huge social media presence. It's small. Mm-hmm. So, but if you want to look us up on social media, you can find us.
Your Instagram videos are doing well. I like them.
Yep. So you can pop us on there. And, you know, like I said, we don't do a crap ton of marketing, but we do some social media just to keep the awareness for certain topics out there.
Awesome. Fabio, I appreciate your time as always. And we'll sit down and we'll do something.
Let's do it.
Some other time on some other topic that comes up that's important.
Yeah, whatever you want.
All right, brother.
Okay, man.
Good seeing you again.
Ciao.